Hello, everyone, and welcome to today's lecture on the Greeks for options. In this session, we'll focus on three of the most important Greeks: delta, theta, and vega. These measures tell us how sensitive an option's value is to changes in the underlying asset price, to the passage of time, and to volatility. By the end of this lecture, you should be able to understand what these Greeks represent, how to use them in trading and risk management, and some of their limitations. Let's begin with delta. Delta measures how much the price of an option changes when the underlying stock moves by $1. For call options, delta ranges between 0 and 1. For put options, delta ranges between -1 and 0. How to use delta. Suppose a call option has a delta of 0.6. This means if the stock rises by $1, the call option will increase in value by about 60 cents. Similarly, if the stock falls by $1, the option will lose about 60 cents. Delta is very reliable for small price changes, but for larger moves, it can become inaccurate because delta itself changes. That's where another Greek, gamma, comes in, but for now, we'll stay with delta. What do traders use delta for? Delta is used for two main purposes. First, hedging. A trader can construct a delta-neutral portfolio where gains and losses in the option are offset by positions in the underlying stock. Second, directional exposure. A high delta option behaves like the stock itself. For instance, a deep in-the-money call with delta close to 1 will move almost dollar for dollar with the stock. Let's talk about some examples. First, you buy a call option on Apple with a delta of 0.5. Each option contract covers 100 shares. That means your option behaves like owning 50 shares of Apple stock. Another example, a market maker sells 200 call options, each with a delta of 0.4. That's equivalent to being short 8,000 shares. To hedge, they might buy 8,000 shares in the market. Next, let's move to theta. Theta measures how much an option loses in value simply as time passes. This is also called time decay. Almost all long options lose value as they approach expiration because there's less chance for the stock to move in a profitable direction. If an option has a theta of -0.05, that means it will lose about 5 cents in value per day, assuming everything else stays the same. Theta is not constant. Time decay speeds up as expiration approaches, especially for at-the-money options. Also, big price moves or volatility shifts can overwhelm theta effects, so it's most reliable in quiet markets. Option sellers love theta because they collect premiums that shrink over time. For example, selling short-term options allows them to profit if the stock doesn't move much. Option buyers need to be careful because even if the stock price doesn't move against them, they can lose money due to time decay. Let's talk about some examples. First, a trader sells weekly at-the-money options on the S&P 500 ETF. As each day passes, the options lose value and the seller profits from theta decay. Another example, an investor buys a long straddle, which is a call and a put at the same strike. If the stock stays flat, the position loses money every day because of negative theta. Finally, let's discuss Vega. Vega measures how much an option's price changes when volatility changes. Specifically, it tells us how much the option price will change if implied volatility goes up or down by 1 percentage point. Suppose an option has a Vega of 0.25. If implied volatility rises from 20% to 21%, the option price increases by about 25 cents. Vega is highest for at-the-money options and decreases as options move deep in the money or far out of the money. It's reliable when there's a broad change in market volatility, but it might not capture all risks in very specific situations. Traders use Vega to speculate on volatility. If they expect volatility to increase, they might buy options with positive Vega. Others sell options in calm markets to profit from a decline in implied volatility, which creates negative vega exposure. Let's talk about some examples. First, a trader buys a straddle on Tesla before earnings. If implied volatility spikes, the straddle gains value even if the stock doesn't move much. Another example, a trader sells options when markets are calm, betting that volatility will remain low. If implied volatility falls, the options lose value and the trader profits. Let's wrap up. Delta tells us how sensitive an option is to price changes in the underlying. Theta tells us how much value an option loses each day due to time decay. Vega tells us how sensitive an option is to changes in volatility. Together, these Greeks give traders powerful tools to manage risk, design strategies, and anticipate how options will behave under different market conditions. This concludes our discussion about Greeks for options. See you at the next lecture.